Moving forward into our main topic, we have it's inspired by this brand new company launching what they call a continuous securities offering. And so, Herwig, this San Francisco-based startup raised $1.2 million in pre-seed funding, seeking to provide a platform to allow investors to invest in a company's future revenue instead of their business equity. This company, of course, I'm referencing is Fairmint. And so the goal for Fairmint was to bifurcate the company's revenue from their equity value. And this stems from the lack of success of many of the 2010s era startups that have now entered the public markets and not succeeded, like WeWork, Uber, or most recently, Casper. And so Fairmint CEO Thibault Favre believes that he has found a happy medium between ICOs, which were too founder-friendly, not providing investors with any real protections, and straight equity, which he argues is too investor-friendly and puts too much stress on the business and is unfair. And so let's break down his vision for how a CSO would work according to Fairmint, again, a continuous securities offering. And so let me break it down for you. The first step here is that when a company decides to launch a CSO, they first stake a percentage of the company's future revenue into an escrow account for a set period of time. So for the sake of example, let's say you want to stake 10% of the future revenue of the business for the next 3 years. At this point, they conduct the token sale, which essentially they allow the investors to buy the token, which represents a share of the 10% over the next 3 years. From there, the initial price per token will be calculated by a proprietary algorithm that bases the size of the reserve as well as other factors. And then from there, it will be traded freely between investors on Uniswap exchange based off of market demand. So Uniswap already live, already trading security tokens. We've seen this happen before, and the price per token obviously will base on market demand of how much revenue you think this company can generate over the next 3 years. The token also has a built-in redemption price, which is determined by another algorithm, which is based on the revenue change over time, which allows investors to see what essentially the par value of the investment is at any given time, which provides a theoretical book value in which investors can use to evaluate the token's future potential. Right? So you're saying, okay, look, at the bare minimum, I can exchange this right now for $20. So at the very least, this token should be $20, and at least it gives that kind of price floor so that investors can then base the rest of the price off of, instead of an ICO where it's just kind of something random and it goes wherever. No, we have some kind of base set here, and again, the company raised the money, so they likely would need to have a reserve just in case some people want to exchange this token, and I'm sure that there's pieces there that they've already weighed out. And then finally, at the end of that 3-year period, right, so we had 10% of our revenue over 3 years. At the end of the 3-year period, the company is obligated to purchase all of the outstanding tokens back from investors at the face value of the last token issued at the beginning of the offering. So if you have 10% of your revenue over 3 years, let's say you sell it for $20. At the end of the 3-year period, the company is then required to buy all of those tokens back, all of the outstanding ones that haven't already been redeemed. They are required to buy all of those back for that initial price, so that, again, investors have that kind of base value, that face value, if you will, for that initial token. And so it's incredibly, incredibly interesting. And Herwig, I'd love to hear your thoughts on where this is going.
I think it's an awesome idea, and I think you get a great overview, Kyle. So thank you for that. But honestly, I think the name in itself is actually a little misleading. The concept of the CSO is really the same as a revenue-based offering, other than the fact that it's not permanent or continuous in that regard. In fact, maybe something like a fixed revenue offering or something along those lines would be a better nomenclature. But I think it's a novel concept in regard because, as you suggested, Kyle, these specific parameters do make it easier to evaluate the potential value, making it seem much closer to a fixed income-like instrument than a high growth opportunity for investors. Which, in this regard, I think Thibault is looking at equity as that option, with the CSO in the middle as that kind of hybrid, and of course debt as that sort of completely fixed type income instrument. So I do also agree with you, though, that it's maybe slightly flawed in the sense that you're probably going to need really strong disclosures, maybe even real-time KPIs to get insight on what kind of pricing and the revenue is doing. And I would go as far as to say that startups and very early stage growth businesses may not even be a good fit for the model unless they can show consistent track record of growing revenues and maybe even at a certain volume, like $1 million plus in revenue. In this case, I'd say that this so-called CSO is still absolutely an STO, but it is a nice twist on the model, kind of like a safe note, if you will. And I'll be very curious to see what type of CSOs they launch with and how investors ultimately end up reacting, because it is definitely novel in that sense. It is a bit of a hybrid. It is, if you will, a little bit more complex from an investor perspective as opposed to just getting a percentage of revenue permanently, getting a percentage of equity, or on the opposite side, essentially determining what your potential yield might be based on the risk associated with the debt or bond offering. In this case, you get a nice little hybrid in between, but I think they've done a lot of strategy and thought into this to determine, okay, how can we help price this with markets? As I think you might have mentioned, this is also a DeFi type opportunity. So in that regard, they have a bit of a different mission than say a lot of these other issuance platforms, which are more focused on just the traditional STO process. And like you mentioned, they're using Uniswap. That's where the Realty tokens trade. So it seems like they've already found a compliant, decentralized exchange to work with. So for a company that is brand new on the map, it seems like they have put together the resources, the strategy, the partners, and everything else needed in between to go live. So again, I can't wait, Kyle, till we hear your updates on the CSOs that Fairmint will be launching in the future.
Yeah, for those who are out of the loop, this is one of the newest revelations coming out of the DeFi community. DeFi stands for decentralized finance, which seeks to totally cut out centralized parties from the financial industry by building infrastructure that fully relies on smart contracts and blockchain technology to provide the accountability and reliability that centralized parties like investment banks and financial service providers would traditionally contribute in a legacy system. And so that's why they partnered with Uniswap, the decentralized exchange designed to create this DeFi ecosystem that still follows global securities laws. And it's as you said, it's the exchange that powers liquidity for Realty as well. And so this company believes that the revenue is a much more productive incentive mechanism for businesses, which I actually totally agree with. Not only is it much easier to evaluate and apply a multiple compared to equity valuations that we've seen kind of blow up over the last 5 or 10 years, but I also believe it's a much more sustainable model as it encourages companies to focus on making money instead of the traditional VC loss leader model, which kind of aims to starve out healthy businesses until they can monopolize that industry. The other thing that I think is incredibly interesting about this token offering is the time length, the expiry date. And so the fact that we can issue a security token that has buyback clauses built in and allows for all these flexible financing rounds and debt instruments and really fancy and complex debt instruments, kind of like this, as you mentioned. It is kind of a fixed income sort of structure here. It's fascinating, and it kind of solves some of those problems. We've talked about early stage companies and how maybe it doesn't make sense to have their equity live on public markets from day one, just because there's no disclosures, there's potentially no revenue, and there's no way to value it. So you're going to have all kinds of crazy volatility as some investors are trying to get out, and some investors have no idea what to value this thing off of. And this kind of provides an opportunity for some of those companies to potentially raise some capital. They don't need to raise 5, 10, 20 million, but they can raise a couple $100,000 based off of the idea that they're going to be able to make some of that money back in that time frame and be able to pay investors back, almost like a bridge loan or something like that, in an interesting structure. And then you take that DeFi aspect of it and you have no centralized party here. You keep the costs very low. You make it a very efficient market. And I'm excited to see how this opens up. But I think you hit the nail on the head that this is a security token. This is absolutely a security token. This is an asset-backed token offering. It's a different form than an equity offering or a straight debt offering. This is something slightly different, but it still falls under our umbrella. I'm excited to see what happens, and I will absolutely keep you updated on their offerings in the future.
Yeah, I think you made an interesting point about adoption there. You got from one side of the perspective, it's kind of like a new model. Again, I kind of referenced the safe note. It could be a new way for entrepreneurs or investors to get exposed to something that's not as high risk as traditional equity, but isn't as limiting as, say, a debt instrument. And at the same time, as you suggested earlier, Kyle, this could be a whole new model for a specific type of business. In the case of Casper, I think it's a great example, right? The equity value may not be worth as much because at the end of the day, it's still losing money. But if they're able to offer something that investors will get exposed to top line revenue while the equity grows and the business continues to grow, and they have something that necessarily is something that they want to offer to investors a little bit more attractive than, say, a debt offering or a bond offering, a corporate bond, well, then perhaps the CSO or FRO, if you will, might be a better option. So again, super curious to see how the market, both from an issuer and an investor perspective, ends up adopting. Again, it is exactly one of those new novel concepts that only security tokens make possible because of buyback clauses, because of programmatic reserves, and all these different features that you can enable. I see something like a CSO, if you will, Kyle, in a traditional format completely not working. So I'm excited to see how this comes to market, and I'm curious what you, our amazing and beautiful listeners, think about this model as well. Be sure to reach out to us. Let us know on Twitter, LinkedIn, our Telegram channel, or connect with us directly at stomarket.com/news. But that is all that we have for today. So thanks once again, everyone, for being a loyal listener, and I hope to catch you again next week.
Talk to you next week.